Middle East conflict exposes Asia Pacific's imported fuel risks, inflicting 25 billion US dollars in energy infrastructure losses and sharpening supply shock concerns. To discuss these energy risks, we have Swati Seshadri of AIFA and Will Simmons of Deloitte. Why are countries that rely on imported fuel more at risk?
So our economies are right now heavily dependent on on fossil fuels. The Asia Pacific region is extremely industrialized and therefore depends on oil, gas, and coal for running their economy. Now, a lot of the countries in this region do not actually extract the oil and gas. Um, they import it, and much of this import comes from the Strait of Hormuz. So we are at the mercy of the global market, which is then influenced by geopolitics as we are seeing it is today. That's a very, very big reason why we are particularly at risk more than perhaps other parts of the world. Fossil fuels are also raw materials, not just for energy, but also non-energy uses. So while depended on it for cooking, for electrifying our homes, for the industry, what is also happening is that they serve as feedstocks for non-energy uses like fertilizers, plastics, textiles, and all these three are important aspects of
Fuel importing countries have limited control over cost and supply of their energy. So global shocks transmit directly into their economies. In Asia Pacific, this risk is amplified by heavy reliance on Middle Eastern energy and diesel-based logistics systems. So when fuel prices spike, costs cascade directly into their economies across transport, food, manufacturing, retail, etc. This drives inflation and squeezes growth. Freight here is the key transmission channels. Over 90% of heavy vehicles in our region run on diesel. So high fuel prices rapidly lift the cost of moving everything. So the real issue here isn't just cost though, it's volatility. Volatility makes pricing, procurement and planning much harder. And this is exactly what we're seeing in our supply shock work. Energy disruption is no longer episodic. It's systemic risk that moves through entire value chains, not just energy markets.
What are the biggest business risks from rising energy prices and shortages?
There is a couple of them which are more important than others, but I think in inflation-driven market compression is perhaps one which businesses will be worried about. Increasing, input costs, the inability of companies to be able to charge higher prices for their products because the economy itself is at risk over here. Logistics costs are increasing, insurance, shipping, everything, all of those costs are increasing. Working capital squeezes are also being seen. And that really affects the margins of businesses. The second is really the reduced demand. Let us understand that it's not just businesses which are affected, but common people's ability to earn and spend is also affected. So with volatility, there's also concern. So citizens would be a little conservative in their expenses. So all of this will also drive down demand, not only for energy, but also for other products, for other, non-essential commodities. And this is like a dual whammy for businesses.
The primary risk is a whole of economy cost shock. Energy is embedded in every part of our economies. It underpins everything that we do. Those businesses that already had challenged P&Ls or balance sheets will be most at risk as input prices increase, and especially if they can't pass through cost increases to their customers. Freight and logistics are particularly exposed with rising diesel and shipping costs, pushing up supply chain expenses and end prices. And then supply chain instability follows, delays, constrained capacity, and a breakdown of just-in-time models. And again, volatility is more damaging than price increases alone. Businesses can adapt to higher costs, but it's much harder to cope with unpredictable swings. I'm already seeing this in markets across the region, that demand's softening as consumers absorb high energy and food costs.
What should businesses do now to avoid future energy shocks?
Of course, I mean, reliance for energy purposes, relying on renewable energy would be the way to go for, food establishments. For example, moving from dependency on fossil gas to electric cooking could be a way to find a way out of this. Having said this, I think the biggest role, actually, more than even the businesses, is that of the government. Uh, there needs to be a very clear policy to scale up renewable energy. Some countries are doing it well, including India, but also in terms of accessibility of this renewable energy to a greater number of people across the region. Um, and so, therefore, scaling that up, making it more accessible is one thing, but also for non energy uses. Like I mentioned earlier, fertilizers, plastics, and textiles are big non-energy consumers of, users of fossil fuels. And on all these 3 points, it's very important for the government to take policy steps. Number one, on fertilizers, really moving to agroecological practices, and for the government to prioritize, subsidize, and support these practices, including subsidies for non-synthetic fertilizers. This is not happening only a moment in time. This is a vulnerability that has been exposed, something that can happen time and time again, and something that we can't depend on. So I think it's important for businesses to have a long-term view, along with, of course, dealing with short-term crisis, but really think long-term and see how can we reduce our dependency on fossil fuels, not just oil and gas, but even coal, and support and work with the government on how policy can be built tailored to transitioning away from fossil fuels.
Resilience is becoming the new competitive advantage, but it comes with a real trade-off against cost optimization. For years, businesses have optimized for efficiency, lean supply chains, lowest cost sourcing, just-in-time delivery. That reduced cost, but it increased fragility. So the question now is no longer what's the lowest cost approach? It's how can we operate through disruption when others cannot? And this is what Deloitte's Supply Shock series is exploring, what businesses can do to respond. We started with aviation, then food manufacturing, retail, and we've just launched a briefing focused on freight and logistics. Firstly, businesses need to stabilize. They need to secure supply continuity, take targeted pricing and cost action, and reduce immediate fuel and logistics intensity. Next, they need to build flexibility. In particular, they need to shift to volatility-ready commercial models that more transparently and dynamically allocate price risk, including pass-through mechanisms and unbundled offers. They also need to invest in data and AI for faster decision-making. In the future, businesses need to reduce structural dependence on volatile energy sources. This is the second fossil fuel energy price shock in 5 years. They need to understand risk across their supply chains and reconfigure to be simpler, more regional, and less exposed.
Thank you for sharing your thoughts, Will and Saweetie.
Thank you.
Thank you, and goodbye to your viewers.
Again, those were Swati Seshadri, Energy Specialist for Petrochemicals in South Asia at the Institute of Energy, Economics and Financial Analysis, and Will Simmons, Asia Pacific Climate and Sustainability Leader at Deloitte. For more news, visit asianpower.com.